Welcome to another episode of the Financial Armor Show. My name is Jose Rodriguez, investment advisor here at Cooper Financial, and your host for today. Along with my co-host, Tony Shore. How's it going, Tony?
Oh, Jose, if I was any better, my name would be Keith Gangl. That's how good
I think I've heard that one before.
I'm doing. He has heard that one, but when we have a guest as special and as awesome as Keith Gangl on the show, I get excited. I get excited just to be on a show with you, Jose. So I appreciate you having me on your show once again this week. But I have been really good. Great, in fact. Went to a couple of ball games this weekend. The teams that I'm into all won this weekend. So that's good news. The Twins and the Saints won their game up here in Minnesota. But we're having some bad weather today, not snow, but rain, thunder, possible tornadoes. So what's the weather like in Arizona? I shouldn't even ask.
Well, it was really bad for a little bit, actually. We went up to the 90s. This early in the season, it's not good. So, but this morning.
Wait,
because
Keith, did you hear that?
Yeah, here's the reason why.
Here's the reason why.
Because I'm just, when it gets to 90, I just picture 120. I'm already sweating. It's 90 degrees, and when it's 120, I'm just gonna be praying it was back in April, March. So I just don't like the summer. But anyway, this morning actually was 50 degrees. When I woke up this morning to go to the gym, I was actually kind of chilly.
Do you like that weather a little better?
I like the cold. I like the colder, not freezing weather, but I like colder weather.
Otherwise, we could swap.
Yeah, we could switch. I'll take 90.
Yeah,
I'll take the dry heat and 90 in God's country, Arizona, for the 9 months of winter.
Can we do an exchange where I come and try to be an investment analyst for a month? That would be really fun. I would take that any day.
Yeah, we'll send Lisa down there and swap with you. Is that what you're looking at?
You want to swap out with Lisa for a while? She could try your job. You could try hers. Is that what you're saying?
I'm afraid because they're probably not want to give her back after she's taken. And then you guys kick me out, and then I don't have a job.
I don't know if you can compete with Lisa. She's really good at her job. She's really sharp at grading investments there, and we'll have her on the show sometime as well, Jose. But tell us, Jose, about our guest today.
Yeah, so we have Keith Gangl here today, which I'm very excited about. He is now the senior senior portfolio manager, right? Is that your official new title?
Yeah, that's what Tony likes to say.
Senior. Senior.
I knew that was coming.
Senior portfolio manager.
Which we've had in the past, and before he wasn't senior. Yeah. So now the facial hair, the gray hairs are now matching the title.
Yeah. And the no hair.
And the no hair.
Yeah.
But the goal for today is to really kind of check back in and with what the updates have been on the tariff and the market volatility and trying to just give an update on how to deal with these tariffs and what these volatility that we now have and is most likely going to be here for the rest of the year. What are your thoughts, Keith?
Yeah, that's a great question. Unfortunately, we're still talking about tariffs, and that's the big news. I've been doing this, dating myself with my hairline too. Has been doing it for about 30 years, and obviously this last month or two has been very interesting. Obviously, since the beginning of April, I think you and I were talking about it earlier. April 2nd, the self-proclaimed Liberation Day. I'm not sure exactly what in the short term what we're getting liberated from by maybe our wallets and the stock market.
We'll have to see.
Hasn't been that great so far.
Right.
But anyway, I think ultimately the things that we're doing because it could be a good thing, but I think that there's a little bit of mismatching in time. That's kind of what the market's trying to figure out, right? These longer term benefits with the short term tariffs. Obviously, if we want to talk about the basics of tariffs attacks, right? So any tariffs that we're getting on goods that we like to, U.S. consumer, no one likes to spend more, do they, Tony? I mean, we love to spend. So we import a lot of things, and that's one of the things that Trump wants to do with this, tariff, war per se, is he wants to fix our trade imbalance, and one of the ways he's trying to accumulate or achieve that is through tariffs. So your question is that's creating a lot of volatility in the market. So I think that's here to stay for, we've seen moves in the market, again, I've been doing this a long time. A week and a half ago, 2 weeks ago, that was the weirdest week of stock market performance. And I almost 30 years. And there's been bad periods in there. This isn't as bad as like 2008, 2009. This is kind of more, I would call it self-inflicted. So I think it gets changed.
Right.
And that's where the volatility is coming in, right? Because all of a sudden on April 2nd, when all these tariffs get announced, way bigger than what surprised the market was, 10% across the board. And then on top of that, he was layering on to fix the trade imbalance, all these additional tariffs. So there was countries getting hit with, Vietnam at, 64%. China was at 100%. Now I think it's up to 145, So
Yep.
there's definitely a lot of weird things. So the market doesn't know what to do with that. And the market sold off pretty aggressively for several days. Then you fast forward a week and a half, or not, maybe just a week. Trump comes out and says, oh, by the way, we're putting a 90-day pause on some of these extra tariffs. And the market was up like 9.5%. So that's, unfortunately, right now, the market's trading on headlines. We like to look underneath the covers and kind of what's going on with earnings and GDP growth rate, unemployment, how we make our investment decisions. But volatility is around. I think unfortunately, it's going to be here to stay. But I do think that's going to start to kind of normalize a little bit and kind of get less volatile as we go forward. And as kind of some of these surprise tariffs, non-tariffs are taken on and off the table, I think that's going to at least dial down. If I look out 2-3 months, I think we'll be less volatile than we are right now.
Right. So, and now I guess to decrease the volatility from now to the end of the year, people need to see or are looking for some progress in the negotiations. Which what have you noticed have you noticed any progress in the negotiations with the big? Now the focal point has become Asia. It looks like.
Yeah. No, I'm been more optimistic than this whole time. I continue to be that way. I do think we're finally starting to see signs of end of last week, the beginning of this is the beginning of the week. This week, as we record this, is starting to see signs that Trump's willing to negotiate some. I think I'm still in the camp of the art of the deal. I think his first foray of announcing these potential deals and tariffs is start with the most aggressive and kind of start walking your way back. And the problem the market had for the first week and a half, there was no walking back. I mean, again, it was, this is kind of the end he wants to achieve. This is what it's going to be. But now he's starting to soften his language with it a little bit. And I do think that you're starting seeing, I think what's going to give the market some confidence, and it's kind of why the market's kind of bounced back here some, is we'll see one country sign some kind of tariff agreement. Again, when they sign these tariffs, these are longer term things. Even when they sign it, it's going to be more of a kind of understanding or kind of end goal. It won't be the finalized thing. That could be 6-12 months plus. So I think, but if you see a Japan or a UK or somebody like that kind of saying, okay, yeah, you want to put 10% tariffs on us to achieve these goals. How about it be 5%? Maybe there'll be some tariffs at the end of the day. Don't get me wrong. I don't think we're going back to zero, but maybe they're going to, like for Germany, for example, they put 10% on the cars that we export to them and we charge them 2%. Maybe our 2% goes to zero and their 10% goes to zero, which in the end, that's good for our U.S. car makers to be able to export stuff to Germany. I think that's the kind of deals and announcements we'll start to see. And the market, I think, is becoming a little hopeful that that's a possibility, where if you back up a couple of weeks ago, it's like, that's not going to be the case. You got China at 145.
Right.
Europe's going to 60, 70, whatever the numbers may be. And it's going to get no one wants to see a complete out tariff war, right? Because both sides lose, because it's, tariffs are taxes. No one likes the word tax. Tony, you like the word taxes?
No.
I didn't think so.
No, unless it's followed by the word free.
Tax, oh, wow.
Yeah.
But boom.
Exactly.
That's
exactly. I love to hear about taxes when you're talking about minimizing my tax burden or tax-free options.
Yes.
Otherwise, no.
And that's one thing that we're focused on, obviously, on the volatility and kind of tariffs. But I do think that's getting forgotten in behind the scenes. I think that's starting to bubble. I mean, last couple of days, I've also seen stories on potentially getting back to what most people wanted it, when the first thing, the administration would do was actually extend the tax cuts that were in place from, 2018-19, have those, because they're supposed to sunset end of this year. And I think that would give investors a little more hope, and kind of, I think that could be that positive catalyst and also reduce that volatility that we were talking about.
Yeah, and that should be a long hanging fruit for them, because they have the votes to extend it, no problem.
Yep.
So I think I don't know if I read it somewhere, and I think it should be happening in the next month or so.
At least the outline of it, right? That's kind of what
Right.
they're, in the last couple of days, I've been reading kind of some more things starting to come together on, the salt and different things like that would get thrown into this as well. So I think unfortunately, just like they always do, they'll kick the can to the last minute. My guess is the deal won't get done until fall, but at least now it's starting to at least start talking about
Target.
it.
Yeah.
Take some of this news flow away from tariffs, which is causing all this volatility. Because at the end of the day, I think the tariffs will be less. This tax thing will be a good thing, and so then I think everybody can take a sigh of relief and just saying, okay, what's the end goal here, and maybe some measurable things that are going to actually transpire.
Right. And like I said on the last podcast when we talked about this, and that's kind of how I read into this whole tariff situation, Liberation Day, is that he's just pretty much shooting at the stars, landing at the moon. And I think I've used that term even.
Yep.
I remember in November when we first found out. Like I was talking to Keith. I think I went to Minnesota, and I think I said the same thing. He's probably gonna shoot at the stars, landing at the moon, kind of thing. And we've seen that he's going to
Yeah.
walk back a little bit, and it's just like a negotiation tactic. It's just an anchoring, starting from here and then coming back up.
Yeah, I think.
But
go ahead.
Yeah, and it was just the volatility that it created is just wasn't. The market sometimes just thinks the worst of the situation.
Oh, it's just a lot of us investment guys are simple at heart, right, Tony? It's like we draw a line from A to B, a straight line, and say, oh, tariffs are going to be now the average of 10%, and all these ones at average of 20. I think it'll end up being like a implied of 25%, which is massive, because just so you know, our implied tariff rate prior to this was like 2.5%. So we're going to go tenfold on the tariffs. I think that's being a little too simple math of saying, okay, all these are going to add up 10, 2.5. I do think they're going up. Bottom line, I do think maybe that 2.5 that we're currently at now goes to maybe 10 as a whole which again, that's a 10% tax. And now what's interesting is we're in earnings season right now, and as these companies come out and give guidance, which I'm pleasantly surprised, we've had roughly about a third of the companies report so far, and we've seen guidance out of a lot more than I thought of. I thought companies as a CEO would say, hey, I'm importing whatever widgets from all across the world that obviously is costing me more. It already went into effect, right? Those 10%, there's a 90-day delay. That's what the market got so excited about. But that 10% across the board, that's still in play right now. So people have to see who's paying for the tariffs, right, Tony? It's like, do you pay, or is the consumer paying for it, which the media like to tell you, or the importers paying for it, or the exporters paying for it? I think it's going to be a combination of all three. Obviously, the person making the widget, selling the widget, wants to pass on to the consumer. But at some point,
for sure,
right?
Yeah.
At some point in time, the consumer is going to say, I can't take anymore. I want to,
right.
Then that 10%, say it's 10%, maybe, the consumer's going to eat 5, and then maybe the person selling the goods and making the goods each 2.5 a piece. I think there'll be some math that way too. And the companies are trying to figure it out. And that's what they're giving guidance when they're a little bit wider than normal. But so far, knock on wood, earnings have been a little bit
But we
better.
don't know how it's going. We don't know because we don't have numbers yet, because it's going to take time.
It takes time. And the companies don't know themselves, right? They're going to pass they will try and pass as much as they can on the consumer until the consumer finds a substitute. So that's kind of where we're at right now. And that's, to your point of why I'm talking about this, that increases volatility, right? So the more unknowns, the more uncertainty, that increased volatility, which then you have, these big up days of, 5, 6, 8, 9%, but then you have these down days like, oh, things are getting worse, or you're getting 3 to 5% down days, which is really not normal when you look at the course of time.
Right.
And we've talked about this on the podcast as well, that a lot of the people that are clients of ours have not lost a whole lot of money, especially when on Liberation Day, when it went down almost 16% in one week. Thankfully, because of the portfolios that you guys make, we were able to give our clients peace of mind. And I wanted to touch on those and what some of these portfolios that have been resonating with our clients, and especially in the times where volatility is high. And then just as give a number of how volatility has changed in the year for the year to date, is the VIX, which is a volatility index, has gone up 40% year to date.
Yeah, it's a lot, and
that's huge.
The volatility index, people in Wall Street generally refer to as the fear index, and that's when you saw at beginning of April, it went from, it's been hanging around, it's been a little bit lower than it probably, in my mind, it should be, kind of hanging around that 13 to 15, spiked all the way up to 60, which that's a big spike, and now it's come back to about 25. To your numbers, that were probably about 40% above normal, and I think that it's going to stay above normal, but at least at 40%, I think kind of compresses as we go throughout the year. So I do think that's going to be the case.
Yeah, and and I want this to be educational for our clients that already have this particular portfolio that I want to bring up, but I wanted to leave it up to you and see how and explain this particular portfolio.
Sure.
Maybe it's a little bit different than how I explain it, but the Buffered Outcomes ETF portfolio, it's one that's become very popular because it's very highly liquid
Yep.
and at the time, I think it's right now it's providing 15 to 16% buffer, weighted buffer. Is that
Weighted.
correct?
Yep.
Right.
Sure.
And when the market just dropped 16% and the S&P, I mean, um, most of the people that were in this portfolio lost very minimal, if anything, at all. So explain to me, what is the Buffered Outcomes ETF?
Yeah, Buffered Outcomes ETF portfolio is going to be a portfolio that's going to have several ETFs in it. There are 6 to 8 different ETFs that are buffered ETFs, which, if your clients are familiar and you're familiar, maybe they're familiar with the fact that, a buffered, like a individual structured note, is like a point-to-point solution. Our ETFs, nice thing about they're not necessarily point-to-point. They're capturing whatever the value is every day long, all day long. And to you, like I said, if we look at the kind of the composite of these 6 ETFs and say, what is the actual buffer protection? Again, some may have a 25% buffer, some may have a 10, some may, mature in July, some may mature in December, some may be on the S&P 500, some may be on a different index as well. So there's a lot of different things going on within that portfolio. But if we look at each of these individual ETFs, if you look at the weighted average buffer, it's about a 15% buffer. So in essence, if you held that portfolio for a year, you would roughly have buffer protection currently where we're at, down about 15%. And usually our caps on those, we kind of try to maintain around that 10 to 15% buffer. And that's kind of where we're at now. And more of that defensive mode, we're close to that 15%. And then our caps are anywhere between the 10 to 15%. Again, each one of these individual ETFs are going to have a separate cap level, right? So that means if the markets were to go up, 15%, you, as a whole, that portfolio would probably be capped out at around 12%. So that's kind of how that works. It's kind of like buying an individual structured note, but we have it with ETF. Nice thing about ETF, to your point, is they're liquid. You can sell them. And so the goal of this overall portfolio is kind of capture about 60% of the upside and participate in less than half of the downside. Like, the market are down, 12% with these buffered portfolios. There'll be some lot. I mean, they're protecting you, of 15% if you hold it for the full year, but they'll probably, that if you're down 12 at the end of the year, this thing should be more like down maybe 4, 5% as well, right? Because we're constantly rolling those ETFs too, and right, it's a rolling number as well. So that's the nice thing, the beauty of it. It's you can see, the value of the NAVs out there every day, and you can see what these ETFs are doing. And the nice thing is, we as portfolio managers, now on this downside, when the markets were selling off pretty aggressively, you were using that buffer on each of these ETFs. What we do as portfolio managers decide, oh, there's not much buffer left protection on this ETF. We maybe need to provide more if we think the market's going down, or we can say, well, that's fantastic because we think the market's going to have more upside from here. So then we maybe even lessen our buffer there from the new point and say, okay, now we're going to go out, giving us higher caps so we can capture more of the upside.
Right. And that's where the active management and this portfolio kicks in. And that's something I wanted to bring up. It is an actively managed portfolio.
Yep.
Right. And it's people see that movement, and I think people have peace of mind that they have protection, and also that there is somebody looking at their portfolio and maximizing the protection if protection is needed, and also maximizing rate of return when we expect the markets to come back up.
Yeah, we just did a bigger rebalance in that portfolio a few weeks ago, and due to the fact that we thought the market was absorbing a lot of losses, which those ETFs were protecting us from, right? That 15% buffer, kind of what you talked about. So they weren't down, like you said, your clients weren't down that 12%. They're down to maybe a couple percent because they're getting protected. Exactly. And then we said, oh, okay, well, these, there's not a whole lot left in these buffers because you were getting closer to them. But we also we think the markets are getting closer to the bottom. So we'll have smaller buffers as we refresh these, and maybe instead of being a 15% buffer, maybe we'll move it to a 9. But by doing that, that allows us to participate to a higher cap level. And that's where the active management comes in. The other thing we may do is say, yeah, we're looking, most of the time we're talking about the US markets like the S&P, 500, but maybe we want to look at a subsegment of the market that's been hit a little harder, like the the triple Qs, for example. That's like the NASDAQ 100. Those are your more aggressive names, and those names are down instead of being down 12%. It's something we haven't owned before. Now we're gonna own an ETF based on the underlying index that would be in the US 500. We're gonna look at just these names that have been really hit hard. So that means we can capture more upside to have bigger caps and still have a nice downside new buffer as well.
Right. So on to add on that, if you look at the 100%, allocation of the portfolio, what is the specific allocation? Would you say it's 80% S&P or
Yeah,
is it
it's a little less than that right now with the rebound. So with the S&P itself, roughly about that 75. And then we also have some international exposure in there, which, is 10 to 15. So we think there's an opportunity there. Generally speaking, I've been a big pro US guy, but the US markets, they're showing some broadening out, not only just in the S&P 500 from away from the Mag 7, but also in international markets. So, Lisa, who's our analyst on that portfolio, we were working on it. And she said, well, she sees some opportunity there. I don't know if maybe Tony is because of her background. She's from Austria. Maybe that's why she's pitching. She wanted to invest in the home countries. But anyway, I do think there's some opportunity there that, we have a little exposure there as well, which is nice, right? Because if, those European stocks, they've actually outperformed the US markets by about, I think it's 12 to 14. Depends on your day you're looking at it, but, anywhere from 12 to 14%. Now, that gives us some ability to play there too. But like you said, most of these portfolios are ultimately driven by the U.S., what it's going to do. But we can add that value add by being active portfolio managers saying, okay, let's look at those Mag 7, those kind of triple Qs, which I talked about. It's more than just Mag 7, but that's a big part of that benchmark. Let's add that on the weakness. Let's look at Europe, have a little exposure there for diversification purposes. So it's not like we're just in one ETF that's going to have a 115% buffer with a 12% cap. We're constantly looking at where's the best opportunity. Well, we markets are way up. Maybe we want to add new protection on the buffers. If we have a big up market, we'll say, okay, we'll reprotect. We'll sell something. There's not much left on the cap. Buy a new ETF, right? That's going to have a new buffer of 15% from that point there going forward. That's how we'll manage this stuff going forward.
Wow, that's what you just described is the very definition of actively managed versus just
set it
and forget it in a 401k or an IRA and not worry about it, right, Jose?
Right. Yeah, it's that's where the real value of active management is, shown. But in last year, it did, I believe it did about a little over 9%. Is that what the rate of return of 2024 for the
I don't have those numbers on the top of my hand, but that's that you'll have to check with that. But
the point that I want to make though is that given the protection that you're getting with these portfolios, that amount of a rate of return is pretty good.
Yeah, and like I said, the goal of the thing is ultimately to if it's not a straight investing straight in the S&P 500 or whatever equity index you're looking at, which you would capture 100% up and downside, right? So the way that most of your clients, they don't need that 12, 14, 16% return. They're probably, with the way you build their plans, it's probably that 68. So if you can have a portfolio that kind of captures 60% of upside of an index, and then also provide you some level of protection. That's what these buffers do, right? Whether it's, 10, 15, 9, whatever those buffer levels are, and provides you with overall protection. When the markets go down, this portfolio will go down too. But if you can have it less than 50% of that capture of the downside performance, then it's like, okay, you're winning more on the upside, you're giving up less on the downside. I think for your clientele, that's a perfect solution, right? Because once your clients come in, Jose, they come in and say, I want, obviously they'd like to have 14, 15% every year.
Yeah.
That's probably not how you're building your plans, are you?
No, it's mainly like I always like to say it, it's make the most amount of money with the least amount of risk.
Yeah.
So it's with this we're getting the most amount of protection that we can without sacrificing rates of return, which is always the goal. But I wanted
we're
to
doing as active portfolio managers, right? That's why we're looking at those different parts of the market.
right, and I wanted to kind of bring up another one that is similar, but this one is a structured note, right? And it's called the Buffered Index Portfolio, and which this one provides 100% principal protection. So when I talk to clients about this, they're all they just, this can't be true.
Yep.
And I'm like, well, no,
Too
it's
good to
true.
be
And
true.
yeah, it's too good to be true. So what would you say to somebody that tells me that?
Yeah, we've been doing this for 5 years, and it's based on, certain levels with that 100% level of protection. There's some give up on the upside, right? You're gonna participate with an index. You're gonna follow it to some level of upside. The cap on. Do you have the cap terms on those right now? I think
I think it's 18 or 19% on the S&P.
yeah, for an 18 months, right? So it's like, okay,
Right.
you have that down. So it's basically you're getting buffered on the downside, but say the markets are up 40%, you're only going to be up, that number you mentioned there, the 18%. That being said, for your clientele that are like that don't want the downside risk, that is a perfect portfolio, right? So I don't want to get into behind the scenes how they do it, but we go out every month we offer these different. We have 3 different growth notes and 2 different income notes typically. And one of the ones that's been an absolute home run, our advisors like yourself absolutely love is my clients are nervous about the market. There's certain different things. You can put your money into a CD, right? You can have it in the bank account. You can buy FIAs. Those are all perfectly good solutions. Or we can have these, what they're called structured notes. It's basically it's a contract with this investment grade banks. We go out to 10 different investment grade banks out in the country. These are the largest banks in the world, whether it's JP Morgan, Bank of America, Goldman Sachs, high quality. And we say, we're looking for terms. We're looking for 100% protection on, we're going to look at the S&P 500 at 18 months. You tell us what the cap will be, and everybody will come back. One will come back with maybe 10%. One comes back with 12%. And what do you think we do as investment guru geniuses, Tony? What do you think? Which one are you going to pick, the 12 or the 10? probably going to pick the higher, right?
Yeah,
right.
the
And that's
12.
we're going to pick the 12, right? So we're going to say, okay, and that's what you can offer your clients, and it's fantastic. They're point to point solutions. There's liquidity if you need it. The one thing, I mean, as you go 18 months, you start, say the markets are up 10%, 2 months into it. These aren't going to be up 10%. If market went sideways, as you get closer to your maturity level, which is 18 months, they'll start catching up. So they'll maybe at first, maybe they're up 2-3% if the market's not changing. So then as you get closer to that 18 month, they're kind of where they should be, right? And if they're down 10% as well, as you get closer to that, maybe they're to show down 3 or 4% right away. And then as you get closer to the ending time period, it would show that you're at 0 or not down at all.
Right. Yeah, I'm glad you brought that up because sometimes people expect it to follow on the dot from day one, and
Nope.
and it's just a reporting, just the way it doesn't get priced.
There's leg up on the upside and leg on the downside. But as you
Yeah.
get closer to maturity, whatever the maturity is, whether it's a year, 18 months, 24 months, it kind of trues itself up. So that's why we always tell these people when I'm sure do the same thing is when you're buying these, there's liquidity if you need to get out, but
Right.
you really rather hold them till when they actually mature, because that's when you start getting the true value of what they own.
Exactly. Great. Well, Keith, I appreciate you coming on the show, and definitely I'll appreciate your time, and hopefully we'll get to have you again. Maybe hopefully talked about another topic that is not tariffs.
Yeah, we'll get away
really.
from tariffs and volatility, and we can talk about some of the market.
I'm ready to be done with it.
You and me both.
Trust me. But something that I wanted to bring up just as uh, a seed, I guess I wanted to plant, because the upcoming next shows are going to be very interesting. Keith, you don't know this either, but I am going to get my former economics professors in here.
Oh,
And
wow.
we're going to talk about certain different things, the deficit, taxes. Unfortunately, we are going to talk about tariffs because I do have my international economics professor that I'm close with, and I want to have her come on and talk about what she knows. But it's going to be very interesting.
Great show. Yeah,
that's going to be fascinating.
That'd be great.
Yeah. So tune in for that, and for the listeners and people that are watching on YouTube, whoever, if any of those portfolios resonated with you, please give us a call, schedule a no-cost appointment, and we can talk about how these portfolios can fit in your overall financial plan.
All right. Well, Keith Gangl, Senior Portfolio Manager at Gradient Investments. That's good. Senior Portfolio Manager. Keith, thanks. That was
Thanks for
really
having me.
great. And Jose, thanks. A great show. Before we go, Jose, let our listeners out there know if they do have questions or are interested in those portfolios, how can they get a hold of you to set up a no charge, no obligation consultation?
They can give us a call at 888-390-5277 or go on the show's website, financialarmorshow.com, cooperfinancial.com. That also works. And we'll be here waiting for you.
All right. Thank you so much. And that does it for today's episode of the Financial Armor Show.